Hello and welcome to interest.co.nz. I'm Gareth Vaughan with our regular monthly Never a Dull Moment Currencies Report, joined again as ever by Dan Bell from HiFX. Welcome in again, Dan.
Thank you, mate.
Look, as ever, it's been an interesting time. We'll kick off today with Graham Wheeler, the Reserve Bank Governor's speech yesterday. I guess he's talking about the overvalued dollar and the hot housing market and what he might or might not do about those two issues. He did talk about how he might be prepared to scale up intervention in the currencies markets. Is anyone actually taking him seriously, though?
Yes, it's been an interesting week, and I mean, in terms of the RBNZ and Mr. Wheeler yesterday, they're familiar themes, aren't they? He mentioned that the New Zealand dollar was significantly overvalued, and continues to talk about the stronger property market and the issues with that, and talking around other sort of macro-prudential policy tools that he may or may not use. So it's the currency is still a challenge to the RBNZ. We've had a decent drop in the New Zealand dollar over the last month or so, and as we found out yesterday with the RBNZ's own currency data, when they intervened in April, they sold approximately 256 million New Zealand dollars. So considering we were probably up over 85 cents at that time, we made a low last night of around the 80 cent mark. So the RBNZ's made a nice little tidy profit on their trading position. But in the big scheme of things, I think $256 million is not a lot, and I think everyone was actually quite surprised to hear that it was only that amount. Put things into perspective, the daily spot volume in the New Zealand dollar US is about 30 billion, so 256 million from the RBNZ in the month of April was really just a drop in the ocean. But I think the governor is showing the market that he did intervene, and that was the first time since mid-2008 that the RBNZ has intervened, and it shows an ongoing willingness to use currency intervention to smooth out these spikes in the New Zealand dollar. So I think at the end of the day, whilst a lot of people looked at the amount that they actually sold in April as very, very small and a bit of a joke really, he was quite effective, and maybe not because he was selling, but because of his timing. So he actually intervened at a time when it was quite effective, and clearly the New Zealand dollar was dropped from around the 86 cent mark down to close to 80 cents overnight. So in the space of a few weeks, we've had quite a decent drop there.
So, I mean, looking ahead, if we see further intervention from the Reserve Bank, we should expect similar type moves, that they just try and get their timing right and don't jump in with huge sums of money? Or do you think his rhetoric yesterday, he's suggesting they might throw a bit more money at it?
Yeah, I think he's saying he's keeping his options open, and at the end of the day he can jawbone the market all he likes. But when it comes down to actually intervening, he knows that it's very difficult for a small central bank like New Zealand, like the Reserve Bank of New Zealand, to intervene in the currency market, and ultimately he does want to only do so when it is effective. So I think we have to give him credit for that. At the end of the day, I don't think anyone from a policy or a government point of view really likes the idea of intervention, but if we can smooth these rallies in the New Zealand dollar and get on to these times when the Kiwi is under a bit of pressure and we can sort of push it a little bit lower, then I think that's a good thing. And ultimately we know that the challenges our economy faces from a currency point of view have got more to do with US monetary policy rather than New Zealand monetary policy or the New Zealand economy. So we're just trying to push back on a situation really which is pretty much outside of our control.
He also raised the issue of potentially even cutting the official cash rate if the housing market sort of calmed down, and he talked about his macro-prudential tools and what he may or may not do with the housing market. But I mean, obviously that would be in terms of reducing the dollar, that would be the key thing to do, wouldn't it, at the moment, in terms of the tools that he's got at his disposal? Well,
without a doubt, yeah. I mean, if he cut the cash rate, we would be we'd be under quite a bit of pressure. But I don't think he's going to do that, and I don't think the housing market is going to slow up enough to see that happen in the next year. Maybe it's something that happens a couple of years from now, but really right here, right now, I don't see him cutting the cash rate, and most economists think that he will start raising interest rates, the cash rate that is, next year. And I mean, we've been at 2.5% now for a long time. I think the challenge really in terms of what the Reserve Bank is going to do in the next 12 months is going to move towards Australia, because Australia have been cutting interest rates as well. Their cash rate is sitting at 2.75%, just a little bit above ours, and they are expected to cut rates again, not next week when they meet, but they are expected to cut rates in the third quarter. And if they're cutting interest rates, obviously Australia's our largest trading partner. What happens in the New Zealand dollar to the Australian dollar is extremely important in terms of our competitiveness in that market. And obviously, if the Australian economy is not doing as well, then New Zealand's not going to be doing as well. So I think that's going to be a big challenge over the next 12 months, and perhaps isn't something that we're paying enough attention.
Yeah, look, I mean, obviously, you mentioned the RBA meets next Tuesday, the first Tuesday of the month, 2.75 now. So no change expected next week.
No.
But that, it is, as you say, I mean, it's perhaps getting to the point with the Kiwi down to sort of 80, 81 against the US at the moment, although that obviously could go up again. The Aussie dollar is maybe becoming even the bigger problem for New Zealand, as it's our largest trading partner is Australia. And we had a report this week from Goldman Sachs predicting it could go as high as 90 Aussie cents within the next year. What do you make of that?
Yeah, I mean, I think where we are at the moment against the Australian dollar, we're not far off about a 10-year average.
So 83, 84.
83, 84 cents. So the last couple of months, so we had a break above the sort of 81.50, 81.80 level, and we've had another leap higher against the Australian dollar. We are still kind of reverting to that longer term average at the moment, so you could argue that, we do need to see the New Zealand dollar really start to get a lot stronger and push up over 85 before it starts to become a real issue. I ultimately think we will outperform the Aussie dollar. I don't think it's going to happen overnight, but the underlying trend is there. And I think there are some aspects in the New Zealand economy which are going to give us a little bit more momentum over the next 12 months compared to Australia, where, as we know, that the resources and mining boom is starting to run out of puff. The amount of money that's being pushed into that sector has peaked as it last year, and the prices being paid for a lot of those Australia's commodities have come off a lot and look like they're going to continue to trend lower. One of the economists at Citibank recently is calling an end to the commodity super cycle, and so we've seen commodities over the last 10 to 15 years have this really steep uptrend. That's obviously benefited Australia hugely, but the next few years could be quite interesting to see how that plays out.
And now, I guess, onto the big question that's in the currency markets out there at the moment is the US Federal Reserve, and when they either slow down their quantitative easing or money printing tap or turn it off completely. Everyone's trying to pick when they might do that. Obviously, there's various comments coming out from Fed officials.
Yeah.
Data coming out from the US economy earlier in the week suggesting that house prices going up and consumer confidence improving, but then overnight GDP was revised down and jobless rates were worse than expected. So it's still a bit mixed. But what's your take on the latest guessing game?
Yeah, you're right. The US data has been mixed, but I think the underlying trend is still reasonably positive, and certainly more positive than it has been. And I think if you look at house prices in the US, that to me is quite a big driver. So I think within the sort of the daily kind of noise and data that we see, I mean, overnight, for example, US GDP was revised down slightly. That was a negative. Jobless claims for the week rose a little bit more than expected. So again, that was more of a negative. But I wouldn't get too caught up in that, because ultimately I think the recent rhetoric coming out of the US from Ben Bernanke and the other voting members at the Fed is that, yes, they are open to tapering off some of this quantitative easing that they've got on the table, and ultimately I think that will it needs to happen, so that the underlying situation there is that the Fed have been expanding their balance sheet by about $1 trillion US dollars a year. At some stage, they need to start to normalise that, and everyone's concerned about the impact that that's going to have on the US economy and on the global economy for that matter. Obviously, where we are in terms of global stock markets, if the Fed start to remove the stimulus, investors may get a little bit more cautious, and we could see a correction in those markets. It's been positive for the US dollar, this expectation that they will start to remove some of the stimulus. And I mean, for example, the yields on US government bonds, in the last month or so, you've seen the yield on the 10-year government bond go from around the 1.63% level over 2.1% in less than 6 weeks. And that's a massive move for those US 10-year yields. And if you compare the yield on the US 10-year note to Japan and Germany, there is quite a big premium being built in there now as the market anticipates a stronger US economy and a normalisation in their policy position. So, listen, I think it's not going to happen overnight, but overall, I do think they will start to taper off the amount that they're purchasing. They're going to need to at some stage.
How soon do you think they might?
Well, I think by the end of the year, and that might just be that they might reduce the amount that they're actually purchasing.
Yep. It's $85 billion a month at the moment.
Exactly. So maybe they start to halve that. I don't know exactly how they're going to do it, and I mean the challenge is that they're testing the market at the moment. I think they're testing to see what impact it may have. Now, them taking the stimulus off the table is going to have a big impact on their economy. If you think about the $1 trillion that they're printing is going to have to come from somewhere else. So. Listen, they're not going to take all the stimulus out of the system, but ultimately I think the market has been positioned in such a way that has been short US dollars, and ultimately the market, to me, whilst in the short term it looks like it's long US dollars, overall I still think the market is structurally short US dollars. So it wouldn't surprise me to see the New Zealand dollar, US dollar push back up towards the 81.5, 82 cent level in the next week or so. But overall, I still think we've got more downside potential back towards those levels that I keep sort of talking about, around sort of 75 cents by the end of the year.
Okay. And look, I mean, one of the other points that Graham Wheeler made in his speech yesterday, or one of the many points, was about how the New Zealand dollar closely has been following global equities, which is a point we've discussed here before as well. They have the old sell in May and go away saying over there for the summer. Is that going to play into perhaps a bit more volatility with the New Zealand dollar over the next few months?
I think so, and it's something that's starting to sort of get a little bit more attention. I think again, global stock markets have had a great run to the year. In North America and New Zealand and Australia, not so well in emerging markets, but the US stock market, close to all-time highs or wherever it is today. I think if we did see more volatility there, ultimately that would be negative, and negative for the New Zealand dollar. And it's not the same correlation. The correlation between the New Zealand dollar and the US stock market isn't as close as it was. But I still think overall there's going to be a little bit more risk premium built into the market, and I think that's starting to. I think we're probably going to see more volatility going forward. And overnight was an interesting case of that, where we had a 1 cent range in the New Zealand dollar over a 2-hour period. So there's uncertainty there, and I think whilst you're seeing this consolidation in US stocks at the moment, at the end of the day you can't have negative news being positive for the US stock market, which in some cases it has been, because it means that the Fed are going to keep printing. I think if you're getting more average news from the US economy and investors start to question the outlook for corporate earnings, then ultimately that'll be negative for the stock market and negative for the New Zealand dollar, because I think the underlying growth outlook continues to be quite sluggish for the global economy.
Well, thanks for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with another edition of our Never a Dull Moment New Zealand Dollar Report.